Hello viewers, we'll be going over WTI crude oil. In this video, we'll be going over the day-by-day probability model, how we find the models, and the forecast model for WTI. So back to the technical analysis. Today we're up 20 basis points on the 1 hour chart. We were at oversold RSI, and now we saw a convergence in play for the 1 hour MACD. And as for the 4 hour chart, we are still nowhere near a convergence on the 4 hour MACD. We just got off of oversold RSI, and we have a resistance on the 9 moving average. As for the daily chart, if we extend out, we start to see a divergence in play for the daily MACD, and we're nowhere near or quite near the oversold RSI, so there's a possibility we may head lower. And as for support, if we do head down lower, I would examine the multi-year support, and if we extend out, we see support levels around the price of back in December 21st, 2018, around the price of $48, and we see that as support on that range as well. And if we do manage to make a reversal, the next resistance that I see is where we left off back in February 19th, around the price of $23 or $53.80, and that is our resistance if we do manage to make a reversal. So if we were to move up higher, that price movement is roughly around 8% to the upside, and to the downside, if we were to hit the support level, it is around 3.8% drop. So back to the day-by-day probability model. As we have here, as the day progresses to the 7th day, we see a 100% chance for WTI crude oil to fall between -2% to -4%. Reason why we have this 100% is we only have one sample to base on, and this is the forecast that is the best match to the current trend. So let's examine the day-by-day forecast for WTI. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So I'll compare why this chart is better, or is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to March 17th, 2011 to June 13, 2011. So let me point out why these two charts are similar. So what we have here in the current trend, we average above the middle Bollinger Band for several days, and then we proceeded to break down and touch the bottom Bollinger Band. And next we see a reversal or a reversion to the mean near the end, and we see those points there, and then we also see it taking a slight dip nearing the bottom Bollinger Band right towards the very end. So we start to see a similar pattern here as well. We average above the middle Bollinger Band for several days. Next we proceeded to take a dip, touch the bottom Bollinger Band, and next we revert back to the mean, and after that we finally reach where we are currently at, near the bottom Bollinger Band. So we have those points there. So what we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast are fairly the same. So the model that we just examined was March 17, 2011 to June 13, 2011. Back then, WTI crude oil was down roughly around 3.2%, so WTI crude oil may continue to fall little by little as the days progress. Again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.